Hello and welcome back to Effortless Investor. If you're new here, this channel is all about building wealth through investing, even if you're starting with a small amount of money. Every month I share the progress of my portfolio, the dividends I receive, and the lessons I'm learning along the way. In today's update, we'll look at how my £3,016 dividend portfolio performed during May 2026, how close I'm getting to my long-term goals, what I bought and sold this month, which investments were my biggest winners and losers, and of course, exactly how much dividend income the portfolio generated. Before we get started, I'd really appreciate if you'd consider subscribing. According to YouTube analytics, around 74% of people watching these videos aren't currently subscribed. So if you enjoy following the journey of a regular investor building wealth 1 month at a time, hitting that subscribe button is one of the best ways to support the channel. As always, a quick disclaimer. Nothing in this video is financial advice. I'm simply sharing my own investing journey and documenting what happens when I invest my own hard-earned money into the stock market. This isn't a portfolio created for YouTube views or a hypothetical example. Every pound invested is my own capital, and every gain, loss, and dividend you see is completely real. If you'd like to skip to a particular section, as always, the time codes for each section are in the description. So with that said, let's jump straight into the portfolio update. At the end of May 2026, the portfolio is now worth £3,016, meaning I've officially broken through the £3,000 milestone for the first time. During May, the portfolio gained a return of 6%. What's particularly encouraging is that this follows another 6% gain in April, giving us solid back-to-back months of 6% growth. Now, I know it's easy to look at a couple of strong months and assume investing is always this straightforward, but that's definitely not the case. Investing is full of ups and downs, which is why I think it's important to share every month rather than just the highlights. To help visualize that, I'll throw up the portfolio heat map on screen now. This shows every monthly gain and loss since the portfolio started and gives a much more realistic picture of what the journey has actually looked like over time. Some months have been fantastic, others have been disappointing, but that's all part of long-term investing. Looking at the portfolio as a whole, I've now deposited a total of £2,380 of my own money. On top of those contributions, the portfolio currently has an unrealized gain of 11.16%. I've also locked in £259 of realized gains from positions I've sold over the life of the portfolio, which represents an additional return of 9.94%. If we zoom out even further and look at the annual performance, the portfolio grew by 21.30% in 2024, followed by 8.84% in 2025, and so far, in 2026, it's up 8.2%. While every year is different, it's encouraging to see the portfolio continuing to move in the right direction as it grows and compounds. Overall, I'm very happy with where things stand after May. Reaching £3,000, posting another 6% month, and continuing to build both capital gains and dividend income feels like a solid step forward on the journey. Next, let's take a look at how the portfolio is progressing compared to my original goal. For anyone new to the channel, I track the portfolio against a simple projection model. The projection assumes I started with £100 and then invested an additional £100 every month thereafter. It's not intended to predict future returns perfectly, but it does provide a useful benchmark to see whether the portfolio is ahead of or behind schedule. As things stand today, the portfolio is worth £3,016, which means it's currently £456 ahead of where the target model suggests it should be, which equates to roughly a 15% differential. To clarify, the projected portfolio value for this point in the journey is £2,580, with an estimated growth of 7.5%. What I find encouraging is that the gap between the actual portfolio and the projected portfolio is currently substantial, at least in percentage terms anyway. The combination of regular contributions, capital appreciation, and dividends being reinvested has allowed the portfolio to significantly outperform the baseline model. Of course, there will be periods where the gap narrows and periods where it widens. Markets don't move in straight lines, and future performance is never guaranteed. But for now, it's nice to see the portfolio continuing to stay comfortably ahead of the target and moving in the right direction. Now, while it's great to see the portfolio ahead of schedule, that progress wasn't the only notable development this month. There were two major sales during the month: Ondas and Rigetti Computing. Interestingly, this wasn't a decision that came from either company performing badly. In fact, quite the opposite. Towards the end of May, both stocks experienced a significant price increase, which finally gave me the opportunity to make a portfolio change that I've been considering for a while. In the end, I sold my entire position in Ondas for a profit of £11 and my position in Rigetti Computing for a profit of £29. Now, £40 in total profit isn't exactly life-changing money, but profit is profit. And as small investors, every gain contributes to an overall journey. Following those sales, I reinvested the proceeds into a new position, approximately 7 shares of the VanEck Quantum Computing ETF, ticker symbol QNTG. The reasoning behind this move was actually quite simple. When I looked at my quantum computing exposure, I realized I was essentially making a bet on one individual company becoming a major winner in the space. While that could absolutely happen, speculative stocks have a notoriously high failure rate. A single company can fail even if the wider sector goes on to be hugely successful. And the same goes for Ondas. So I asked myself a simple question. Would I rather bet on 2 companies doing really well, or bet on the entire quantum computing ecosystem growing over time? For me, the second option felt like the more sensible approach. I still strongly believe that quantum technology has enormous long-term potential, but an ETF aligns much better with my investing philosophy. Rather than trying to pick an eventual winner, I can gain exposure to the broader industry and let the market sort out which companies ultimately come out on top. One of the things I particularly like about QNTG is that it already holds many of the major names in the sector, including Rigetti, IonQ, D-Wave, and IBM, alongside a number of other companies involved in the development and commercialization of quantum technologies. So, while I've exited my individual positions in Ondas and Rigetti, this isn't me giving up on quantum computing. If anything, it's the opposite. I'm still investing in the theme. I'm just doing it in a way that I believe offers better diversification and potentially a more attractive risk-reward profile over the long term. With the portfolio changes out of the way, let's move on to the largest section of the portfolio, the EI Growth Pie. For anyone new to the channel, the EI Growth Pie is designed to focus primarily on long-term capital appreciation. This is where I invest in assets that I believe can grow the overall value of the portfolio over many years, while still maintaining a sensible level of diversification. At the end of May, the EI Growth Pie was valued at £2,039 and delivered a monthly gain of 5.8%, making it another very strong month for the growth side of the portfolio. Overall, the pie is now up 15%. That's particularly encouraging when you consider that the growth pie underwent a fairly significant reshuffle at the beginning of March. Since then, the portfolio has continued to perform well and appears to be settling into its new structure nicely. Looking at the individual holdings, the largest position remains VWRL, which now accounts for 80% of the pie. VWRL gained 6.48% during May and is now up 19.23% overall. Once again, it's proving why broad global index funds form the foundation of my investing strategy. Rather than trying to predict which country, sector, or company will outperform next, VWRL gives exposure to thousands of companies around the world and has continued to deliver strong results over the last 18 months. The second holding is WLDS, which gained 5.79% during May and is now up 5.25% overall. While it hasn't matched VWRL's overall performance yet, it's still moving in the right direction and provides exposure to a theme that I believe has significant long-term growth potential. As with many thematic investments, patience will likely be required, but so far the position is doing exactly what I'd hoped it would. Finally, we have SGLN, which gained 0.86% during May but remains down 14.45% overall. While it's never fun seeing a position sitting in the red, this is actually a good example of why I hold gold in the first place. Gold isn't in the portfolio to generate explosive returns. It's there as a diversifier and a potential hedge during periods of uncertainty. Sometimes that means it lags behind risk assets when markets are performing strongly, which is largely what we've seen recently. Overall, I'm very happy with how the EI Growth Pie is performing. The bulk of the portfolio continues to be driven by broad market exposure through VWRL, while WLDS and SGLN provide additional diversification and exposure to themes that I believe can contribute long-term returns. Most importantly, the pie continues to demonstrate that you don't necessarily need dozens of individual stocks to build wealth. Sometimes a small collection of well-chosen funds and ETFs can do a lot of the heavy lifting. Now let's move from the growth side of the portfolio to the income side, where the focus shifts from capital appreciation to generating a growing stream of dividends and distributions. At the end of May, the EI income pie was valued at £734 and delivered a monthly gain of 1.4%. While that might not sound as exciting as the 5.8% gain from the growth pie, it's important to remember that these holdings are designed with a different objective in mind. The primary goal here is to generate income while still providing some potential for long-term capital growth. Overall, the income pie is now up 5.14%. Similar to the growth pie, this section of the portfolio also underwent a reshuffle at the beginning of March. So it's still relatively early days for the current allocation. Starting with the largest holdings, we have JEQP, which delivered a gain of 3.41% during May and is now up 5% overall. This continues to be one of my favourite positions within the income pie, because it provides exposure to equities while also generating an attractive level of income through its options-based strategy. Next up is VHYL, which was actually the strongest performer within the income pie during May, gaining 3.64% and now sits up at 15.9% overall. That's an excellent result and further reinforces why I like combining dividend income with broad diversification. Not only has VHYL been producing income, but it's also delivering some very respectable capital appreciation. Moving on to JEIP, which had a tougher month, declining 2.18%, leaving the position down 3.38% overall. While it's never ideal to see a holding in negative territory, I try not to focus too heavily on short-term price movements with income-focused investments. The key question is whether the investment continues to fulfill its intended role within the portfolio. And for now, the answer is still yes. The fourth holding is INFR, which fell 1.73% during May but remains up 4.16% overall. Infrastructure investments can sometimes lag behind broader equity markets during strong risk-on periods, but they can also provide stability and diversification when market conditions become more challenging. Finally, we have IUKD, which gained 2.41% during May and is now up 1.33% overall. It's still relatively early days for this position, but it's encouraging to see it moving back into positive territory and contributing positively to the overall performance of the pie. Looking at the income pie as a whole, I'm pleased with where things currently stand. A 5.14% overall gain, combined with regular income these holdings generate, is exactly what this part of the portfolio is designed to achieve. Now, before we move on to the dividend section, I wanted to briefly revisit the two speculative positions that I sold during the month, starting with Ondas. As I mentioned earlier, the decision to sell wasn't driven by poor performance. In fact, Ondas delivered exactly the kind of month that speculative investors dream about. During May, the stock surged by an impressive 37.41%. That's a huge move for any investment, and especially for a company operating in a developing and highly speculative sector. Gains like that are one of the reasons many investors are attracted to smaller growth companies in the first place. For me, though, the rally simply provided an opportunity. Looking back, I'm happy with how the investment played out. No, the £11 profit isn't going to change my life, but that's never really been the point. The position generated a positive return, I learned more about investing in emerging technologies, and I was able to redeploy the capital into an investment that better aligns with my current strategy. That's something I think often gets overlooked in portfolio updates. Not every successful investment has to be a 10-bagger. Sometimes a successful investment is simply one that makes money, teaches you something, and helps move your portfolio in the direction you want it to go. And in that sense, I would definitely consider Ondas a successful investment. And if Ondas had a strong month, Rigetti Computing took things to an entirely different level. During May, Rigetti surged an incredible 58%. That made it one of the best performing assets in the entire portfolio. Much like Ondas, this wasn't a position I sold because I'd lost conviction in the technology. I remain incredibly invested in the long-term potential of quantum computing and still believe it could become one of the most transformative technologies of the coming decades. A 58% gain in a single month is fantastic when you're on the right side of it, but it also serves as a reminder of just how volatile these types of companies can be. The same stock that raises 58% can just as easily fall 30% or 40%, or even more if sentiment changes or expectations aren't met. As investors, especially those of us working with smaller portfolios, it's easy to become attached to individual stocks. We spend time researching them, following the news, and cheering them on, but sometimes the best decision isn't asking, will this company succeed? It's asking, is there a better way to express this investment thesis? For me, moving from a single stock approach to a broader quantum ETF felt like the more sensible long-term decision. That said, I'm certainly not complaining about how Rigetti signed off. A 58% gain in a single month is a fantastic result, and it provided exactly the opportunity I needed to make the transition. Now, while the capital gains this month were certainly nice to see, the ultimate goal for this portfolio is to build a strong, growing stream of passive income. So let's get into the dividends and take a look at who paid what during May. In total, the portfolio generated just £3.31 in dividend income during the month. Breaking that down by position, INFR paid 57p, SMIF paid 59p, JEIP paid 77p, and JEQP paid £1.38. As always, every penny received is automatically reinvested back into the portfolio, helping to buy more assets that can hopefully generate even more income in the future. Now, £3.31 might not sound like a huge amount of money, but context is everything. I'll put a comparison graph on screen right now showing May 2025 versus May 2026. This time last year, the portfolio generated just 41p in dividend income. Fast forward 12 months, and that figure has increased to £3.31. That's an increase of more than 700% year over year. Of course, the actual cash amount is still relatively small, but this is exactly why I enjoy tracking dividends. The progress becomes much easier to appreciate when you compare where the portfolio is today versus where it was a year ago. The snowball is still small, but it's definitely getting bigger. Looking at the portfolio's dividend target for May, I had projected that the portfolio would generate £2.82 in dividend income. The actual result came in at £3.31, meaning the portfolio exceeded its target by 49p. What's also encouraging is that January, February and March all exceeded their projections. April was the first month of the year that narrowly missed its target, but May has put us straight back on track by comfortably beating expectations once again. For me, that's the most satisfying part of this journey. The dividends aren't just appearing out of thin air. They're the result of consistent investing, reinvesting dividends, and gradually building positions over time. Every month, the amounts get a little bit larger, and every month, the portfolio does a little bit more of the work for me. And that's exactly the direction I want this portfolio to keep moving in. Before we wrap things up, let's finish with the portfolio's best and worst performing assets for May. Starting with the winner of the month, and frankly, it wasn't even close. The best performing asset was Rigetti Computing, which surged an incredible 58% during May. As we discussed earlier, that rally was ultimately what gave me the opportunity to exit the position and transition into the VanEck Quantum Computing ETF. Regardless of what happens from here, there's no taking away from the fact that Rigetti delivered an exceptional month and played a significant role in driving the portfolio's overall performance. Now, moving on to the other end of the spectrum, the worst performing asset during May was JEIP, which declined by 2.18%. What's interesting is that a 2.18% decline was enough to earn the title of worst performer this month. To me, that's actually a positive sign for the portfolio overall, because it suggests there weren't any major blow-ups or significant drawdowns across the holdings. In the grand scheme of things, a move of minus 2.18% is relatively minor, and well within the range of normal monthly market fluctuations. It's also worth remembering that JEIP is held primarily as an income-generating investment, rather than a high-growth position. So all things considered, May was a very strong month for the portfolio. When your best performer gains over 58% and your worst performer only falls just short of 2%, you're generally looking at a pretty healthy month overall. And with that, we'll bring another monthly portfolio update to a close. Overall, I'm really pleased with how May turned out. The portfolio crossed the £3,000 milestone, delivered another 6% month of growth, remained comfortably ahead of its long-term target, generated more dividend income than projected, and gave me the opportunity to make what I believe is a positive long-term change to my quantum computing exposure. Most importantly though, this portfolio continues to prove something that I talk about regularly on this channel. You don't need tens of thousands of pounds to start investing. This portfolio was built through small, consistent contributions over time. And while the numbers are still relatively modest today, it's encouraging to see the progress that can be made by simply sticking to a plan and remaining invested. As always, I'd love to hear your thoughts in the comments below. What was your best performing investment in May? And do you prefer investing in individual stocks or broad ETFs when it comes to emerging technologies like quantum computing? If you enjoyed the video, please consider leaving a like and subscribing to the channel. It genuinely helps more than you think. With around 74% of viewers still not subscribed, every new subscriber helps support the channel and the journey. And if you're interested in building a dividend portfolio of your own, make sure you check out my video on how much money do you need for £2,000 per month in dividends. I'll leave a link on screen now. In that video, I break down the numbers, the assumptions, and what it could realistically take to generate a meaningful level of passive income through investing. Thank you all for watching. Thank you to everyone who's been following the journey, and I'll see you in the next one.